morning, everybody. John, thanks. So, my name is Dwayne Stiller from Woolbright Development. We're going to give everybody a couple of minutes because I know that some of the sessions are running over. But today's talk, new major retail development. So, what we're going to try to do today is we're going to begin with how is the market performing? How's the retail market performing overall in Florida? After we do that, right, well, one of the things we're going to learn is that construction, from a historical perspective, right, so Florida's about 3,000 shopping centers, and we can kind of think about having been building them since the mid-70s, so roughly 50 years. We know that that's roughly 60 centers a year. And today we're only going to talk about a growth rate that's only around 8. Right? So that's a very different world than what Florida has been over the last 2 generations. Right? So we're going to talk about the consequences of that, but more importantly, we're going to look at each individual project, right? The 8 projects that opened in 2022, the 8 projects that are or will open in 2023, and I'll discuss with you what is going to happen in 24, what's going to happen in 25, right? What does the development ecosystem look like? So briefly, I guess we'll get started when they can start showing up. A little bit about woolbright. So I started woolbright when I was wearing a boy size 20 shirt. I was something like 18 years old. I got my real estate sales license. By the time I was 19, I had my broker's license. I was still in college at that point in time, and I was studying a really interesting subject called operations research and industrial engineering at Cornell University. And later we call it operations research and information engineering, but we were studying big data when big data wasn't cool. I went on to team up with my dad, who was building some public centers. I worked in travelers insurance for a while. I write a lot of cool software. Early on, I wanted to be the next Bill Gates. I definitely was not. But I've been thinking a lot about retail as a big system, as a series of patterns. So a lot of my talk today will come from that. And one of the unique things that Woolbright does, we do a couple of things. Since 2000, we've bought 100 projects in Florida, right? Several, $2-3 billion of projects. Roughly 1 out of every 20 centers in the major metropolitan areas we have owned for some brief period of time. That would put us on par with the Kimcos of the world. Remember now, they're buy and hold guys, and Woolbright is a buy, fix, and sell platform, right? You want to take something that is underperforming, maybe it's a cow pasture, or it's a 50% leased public center in Newport Richey, and we want to move it through our machine and make it a 100% leased shopping center. That's what Woolbright does. And we're about 60 people, and we're based in Boca Raton, Florida. All right, let's go look at how is this market that we're all working in behaving. Now, one of the unique things that we do at Woolbright is we physically visit every shopping center in the major metropolitan areas at least once a year to do a census. Okay? So this is coming from visiting the 2,400 centers that make up the major metropolitan areas of Florida. And what am I talking about in terms of major metropolitan areas of Florida? That's obviously Dade, Broward, Palm Beach, Orlando, Tampa, Jacksonville, Naples, Fort Myers, and Sarasota. All the places where there's at least 1 million people. As a group, those major metropolitan areas are probably 75 or 80% of the population. So we tend to ignore, Sebring, Florida, Tallahassee, Pensacola, not because they're not important places, but because our investment strategy revolved around sticking to the places where there was the most growth and the biggest base of population. Well, one cool thing that's happened lately is that here is 20 years of occupancy or vacancy rates. And you can see that this chart, we've now crossed past where we were in the last nirvana, which was 2004 and 2005, we've now gone into a place where we have the lowest ever vacancy rates. And to give you an idea, we're going to touch on this a little bit more, but in the last 3 years, half of all the empty boxes were leased. 1/3 of all the empty vacant shops were leased. If you show up at an average public center today in Florida, there are 2 small stores that are vacant, soon to be 1, soon to be none. And we all know, let's think about that. What happened during the pandemic when your store ran out of toilet paper? The next time they had toilet paper, you ran for it, and you paid double what you had been paying before. So what are the consequences of getting into a place where there really isn't much empty space? Dade County today has 15 big box sign not open tenants, right? So over the last year, 15 big deals were made. There are only 9 vacant boxes in Dade County. Dade County is 3 million people, the population of Alabama. Okay, like literally, and 4 of those 9 don't have a leasing sign and probably will never be rented. And we're in one of those situations where we are without toilet paper, right? Now we know there's a hurricane coming right now up from the Caribbean, probably hit the west coast of Florida, and we know there's a point in time, if we drive to Tampa right now, or somewhere north of Tampa, like Brooksville, we know there's no line at the gas station, right? But there is something that happens where everybody reaches the conclusion, kind of the same way. We all know 2 days before there's a storm coming their way. There's no variance in the model. The question is, does it hit Wednesday at 7 p.m., Wednesday at noon? But they're all going to wait till Tuesday night to get the gas, right? That's when the panic will set in. That's where the system will, and now the lines will be 2 hours. You could have gone 2 days before there was 0 wait, but you won't. And the same thing will happen in retail. The awareness, you're not seeing that many articles out there, hey gosh guys, there's now 1 store at a typical public center. Hey, there really isn't any boxes left in Dade County. But by coming today, you learn that will be everything that will be talked about in 2024 and 2025, how the retail space in Florida has effectively disappeared. Now today we're going to learn about generally the way you fix running out of toilet paper is you make new toilet paper. Right? Today's talk is all about development. Right? Let's look at another slide. Well, the first consequence is that we've just reached record rent growth. And last year when we checked with the landlords in Palm Beach County that had public centers, we found that they decided to raise rents, not at their historical level of around 3% a year, they raised them by 10%. This year they're on track to raise them by 20%. They're taking a cue from the used car dealers, they're taking a cue in the last 2 years, they're taking a cue from the apartment guys, right? Retail is going to have massive rent growth. Retail will be the new industry. Okay? The industrial space, you had these old buildings for years and years, and then they started building new buildings, but we still had such growth, they all ran out of space, and the rents rapidly doubled. Okay, so, Dwayne, are you kidding me? Can we see $20 shop rents go to $40? Yes. Can we see $15 box rents go to $30? They already are. Okay, so this is what's going to happen, and that's just a backdrop for us getting into what happens in development land. This is an interesting slide. This is the gray bars in the market that you're in. It's no fun developing something if you can't sell it. And the gray bars are the sales in those major markets of shopping centers for more than $15 million. Does anybody want to tell me something about those gray bars? We need audience participation here. You see a really predictable pattern there? Anybody?
They peak right before recession.
Well, they're all over the place, right? There's lots of volatility. You see that? They go up and down a lot. So if you're a broker, it's really hard to know. Last year you had a record year, this year you had one of the worst years ever. How the heck? How do I plan my life, right? But I live in a world where the next 5 years, it could be all over the place. The bar on the top, this is very typical when you study lots of data. This is the long-term trend for cap rate. So the little squiggly line is all the noise that everybody's talking about. Oh, cap rates are going up, right? So we tend to talk about that when we're in a red zone. It's like, oh, the prices are so terrible. And then you'll get into a green zone where the cap rates will be a little better than the long-term trend. I call that the period of exuberance. Oh man, things will never be better than this. This is great. You know, let's go buy a new Tesla, do this. This is life is good. It will never get bad. Right? Every green is followed by a red. Every red is followed by a green. Take a message from Warren Buffett. You can't time the market. Okay, so don't try to figure out. But what you can realize is that cap rates have been following for 20 years that straight line, right? So if this was an SAT question, guessing where the next cap rate is, you could make a reasonable guess at that. But if it was an SAT question, guessing the total number of shopping centers sold or the dollar amount put out, there's too much volatility. There's no really predictable pattern going on there. It looks like, this is really, really important, right? So this will be probably the first and last ICSC conference you'll come to with an inverted yield curve. That's an inverted yield curve. I get that this way. This means where the short-term interest rates in the marketplace are higher than what you have to pay for long-term interest rates. Okay, this is we're in one of those periods of time. They're not usually very long-lived. But what they have done is they've caused the market, right? So that year to date, we have only sold 1/5, 20% of the number of things that we would have sold last year this time. Right? That's pretty, you know, it's like, oh, we had this restaurant, we used to have 100 people a night, today we have 20. Like, you would notice that, okay? Having 80% of the transactions disappear, that's something we, you know, I know a lot of the buzz at this conference is Florida is sizzling. Well, it's not sizzling if you're trying to sell something, okay? It's falling flat on its face. And that would make development very hard. But you'll notice that falling flat on your face, whether it's in 2009 or it's during the pandemic, is often quickly followed by a record year. Okay? This thing is so volatile. So do not become distraught over this. What I'm telling you has historically been a very short-term condition, and that is inverted yield curves. All right. What are we talking about today? We have the best fundamentals for retail that I have seen in 40 years of Florida. Record occupancies, record rent growth, right? And zero net supply gain, right? How cool would that be? You know, you're trying to get a date for the prom every year, you stumble a little bit. There's always like 20 new guys that just came to school for the first time ever from who knows where, and it's like every time it's just, you can never seem to get any traction to get ahead. Okay, good news, there's new guys to compete against. This is it, this is gonna be your year to get a date for the prom. You're gonna fill up those last days that you have because there's literally no new car smell out there to compete against you, okay? None. There's another way to think about that. This is a chart of how the retail space came on since the 1980s, okay? And for a long period of time, it was that straight rocket ship up, build 60 centers a year, everybody came to ICSC with lots and lots of plans of the projects that they intended to do. My dad loved it, he couldn't roll out enough dreams at an ICSC conference. Many of them became shopping centers, many of them didn't. Right? And then it all changed after the GFC, right? And things began to be affected by, one, the capital markets, and two, and if you want to tell me what else probably led to the massive growth slowdown in construction of shopping centers? COVID. No, we're back 15 years ago, 10 years ago. Online sales. Right? So we had a world 15 years ago where there was zero online sales of retail, and today 15% of all sales occur online. 85% still occur in the stores. You're still relevant. If you're here working on stores, right, that, 85% is a lot. Okay, now, See that big red sign? Well, last year when you came to ICSC, you were at peak retail. There was never more space in Florida than last year, and today there's less. And in fact, I predict for pretty far into the future, there'll be less and less space every year. So if you own an existing center, if you lease a center, if you lend on centers, all of that's going to get better because there's going to be less and less space, but ever increasing demand because Florida's population growth will accelerate from today forward. Okay, we're at 1,000 people a day. We're going to go to 1,100 people a day, 1,200 people a day. Right? You're going to move out of Chicago because there's too much crime. You're going to move out of New York because there's too much crime. You're going to move out of California because there's too many taxes. You're coming to Florida, and we're going to have less and less retail space. What else is happening? Because there's some really other cool, complex things before we cover these 16 projects. Okay? Lots of complexity out there. The number 2 grocer in the United States, Kroger, is merging with the number 3 grocer, Albertsons. So they can go and get into the wrestling arena with the big 800-pound gorilla of Walmart. Come on in. You haven't missed the good part yet. Welcome. We've been reviewing the market. We're going to go see everything that's new in a few minutes. Another remarkable thing for Florida was last week, Aldi took their 250 stores in Florida and doubled their store count to 500. You will never see that again in your lifetime. One of the competitors coming out and with a magic button going to 500 stores. So Publix, with their 900 stores in Florida, wakes up and sees all of a sudden somebody that was 250 is magically 500. And it's a company that's controlled by a dude that has like $15 billion and 10,000 stores in Europe. Okay? So like they are not new to digesting big expansions. They're not new to growing. This morning you may have looked at the news that Kinco, fresh off of having bought Weingarten during the pandemic, bought RPT properties. Right? They announced that. So there's another $3 billion of properties that makes it into the Kinco ecosystem. So the REITs, right? Regency bought Verstat during ICSC Vegas. Now Kinco announces that they're buying RPT. So the REITs are continuing this effort of consolidation, right? Kite went out and bought somebody. You've got your grocery store chains, right? They're consolidating. They're saying this is going to be an extremely competitive marketplace. And so against that backdrop, let's see, part of making their machine work is adding new locations, right? Part of all of our retailers, part of all our tenants work is you want to grow sales. One of the easiest way to grow sales is add new stores. One of the easiest ways to add new stores is become a tenant in a newly built shopping center. Okay. Well, in 2022, we built 7 projects, and in 2023, we will open 9 projects. I'll give you guys some secret information. In 2024 and in 2025, it will be 4 or 5 projects. It will be half. You're like, hey, you just told me your population is going to grow up a lot. What do you mean we're going to have half the new projects that we have now? And you just told me that this is off of a historical average of 60 centers a year. We're now at 8. Like, okay, that's just what the world is. Now, I will tell you, I'm always getting in trouble here. They have to put a shot collar in the woolbright. Oh, don't give away our secret sauce. This is the time you actually want to think about building new shopping centers. Okay? Why? Well, because when everybody lines up at the gas station, they would be willing to pay a whole lot of money to move to the front of the line for gas. When there's no toilet paper at the store, you'd be willing to go from the $2 a roll normal price to $10 a roll because you really want to go home with some toilet paper. Okay? And so, what you're going to see going forward, the reason we have so few things being built is that we have a problem with one of the most important first principles of development of real estate. Who wants to tell me what first principle are we struggling to achieve in development? Return on cost or making a profit. We need to sell these things for more than they cost us to build. And right now, the costs are pretty much given to us. They're driven largely by this massive expansion in Florida of multifamily construction, big warehouse construction expansion. And so our costs are somewhere around $500 a foot, maybe as high as $600 a foot, excluding the land, right? Now think about that. If you're gonna pay $200 a foot for the land, or your all-in costs are $800 a foot, and you wanna make a 6% return, which a lot of people would be happy with 6%, but 6 times 8 is 48, meaning you need to average $48 a foot. Think about the last time you had a center that averaged $48 a foot. Okay? Well, you can see developers like my dad, they're pretty creative dudes, they roll up a set of plans. They're gonna try to tell you they can average $48 a foot, and you'll say, great, go get me an anchor tenant so that you can convince me that and give me a couple of nibbles on what's left and convince me that there is a $48 a foot way forward. And in fact, it doesn't exist. Now, there's an interesting component, and that has disappeared. You're gonna learn about that now. Of these 16 projects I'm gonna show you, first of all, they're concentrated in Dade and Orlando. More than half is gonna happen there. So as you drive around Orlando, you'll notice this big population growth, this increase in multifamily. We're getting the retail projects there. Obviously, Dade, Broward, big population growth. We're getting the projects there. Hardly anything today you're gonna see in Jacksonville, and so on and so forth. And even, remarkably, hardly anything in Tampa. One thing you will see as we talk about these projects, there's roughly $3 billion worth of projects. Much less than $1 billion of the projects I'm going to show you, $1 billion of the value, was created by the retail. 6 out of 8 of these projects have a huge multifamily component. In other words, building retail space in Florida today and in the near future is synonymous with building multifamily. You have to have been able to do both things, or you have to create a strategic partnership that is synonymous with that. Now, there's some other interesting news you're going to learn about other than the merger with RPT today, other than the details of the Aldi Winn-Dixie merger, and that is the biggest buyers of apartment land have changed as of last week what they'll pay for apartment land. I'm going to do a quick show of hands. Who here thinks they've reduced their price by 30%? 0 to 30. Okay, thank you. That's reasonable, right? It's a $10 million house. They've reduced it down to 7. Still going to get something, right? No, that's not the right answer. Who thinks they've reduced the price they're willing to pay for your land? Your land was $10 million. Who thinks they've reduced it by 50%? They're going to offer you half. Okay, I get a lot of voters, but okay. Who thinks they're going to be pigs? Little piggies, okay? And they're going to offer you 2/3 off what you want, and they're going to go 1/3 of what they're going to pay last year. Yeah, that's the new number. Now, if you woke up and you had one of these 5 projects a day, majority of which had a lot of apartments, and the dude or dudette that was buying the apartments from you, like magically call up and say, hey, I got a little problem. Remember that $10 million check I was going to give you? What's 3? You're like, what? 3? Oh, hold on, wait a minute. Like, that was all my profit. Yeah, right? That was all my profit. The apartments were, so this is a big change. And so I'm going to show you today what the new world of retail development looks like, because this is the old world. These projects were conceived back in 2018, 2019, when you could get a big number from the apartment tax. You can't get that as of today because their cap rate went from 3.5% to 5%. Okay? I will do the math for you. And they tried to recover most of that change in lost profit by beating the daylights, because they couldn't do it with the contractor, out of the land sale. Okay? Now, none of these dudes and dudettes are going to get any new apartment site, just like you're not going into a $10 million neighborhood and offering $3 million for houses. You're going to go home without any houses. And so they're going to have to adjust their business plan at some point. Probabilistically, they adjust their business plan when the cap rate has reverted more to the mean level, and the Fed has been cutting rates for a while, and they'll return back to the marketplace. Okay. Doral Square is in Miami. It opened in 2022. Notice that you want to build in Dade, one of the themes is going to be good. Have 3 levels of tenants. Forget this one-story thing that we've been doing for the last gazillion years, right? And we'll put Ross and Marshalls on the second floor. We'll put the fitness guy on the top, so on and so forth, right? Notice that, USC gym, home goods. Notice the rents, right? Dade County, $55 to $65. That's the number you're going to have to average, right, in order to make a return on your invested capital when the construction costs, excluding land, are $500 a foot. All right? Let's go. So we're going to quickly tour every new project. This is rapid education. Save you from driving around. You can go back and visit all these later, right? So here we don't have any multifamily, right? We're down in Cutler Bay. Publix finally gets their second store to take the pressure off another store. Here's some local tenants. That's typical of what we saw, right? Now we get to the second Terra project, right? So we're going to do 5 projects in Dade. This project has the 350 apartment units, right? We've got a NDA grocer. Anytime you see NDA, non-disclosure agreement, that's a code word for an Amazon meeting. We all want, right? So it's like, you're not allowed to put Amazon, so you just put grocer NDA, wink, wink, right? Because none of us wants to have a leasing plan where it's like box to be determined, anchor to be determined, right? Now, we talked about complexity, right? Because that's what's underlying this. We talked about Albertsons and Kroger merging. We talked about Winn-Dixie and Aldi merging, right? We haven't talked about Whole Foods. We talked about Publix's 900 stores. Anybody want to tell me how many Whole Foods are in Florida? 30. Okay, there's 900 Publixes. Everybody says they live by a Whole Foods. You don't live by Whole Foods, you live by Publix. There's 900 of those. Okay, there's 30 Costco's, there's 30 Whole Foods. Now, anybody want to tell me how many Whole Foods are in Doral? Big area, right? Yeah, none. How many Whole Foods are in Kenton? None. You're like kidding me, there's 500,000 people in Kenton, how could there be no Whole Foods? Coming that a little bit, okay, because these retailers are going to need new places. There's no empty spots in Kendall. There's no empty spots in Doral. That's a conundrum. But could you imagine being the Terra guys and waking up, and every article you read about Amazon Fresh is how they haven't gone forward on any of their deals, and how they've been waiting 3 years in Florida. The poor Schmier and Fuhring guys in Glades and 441 sat with a converted Lucky store waiting for their Amazon Fresh to open. It's no fun to have a conversation with your lender. It's no fun to have a conversation with your investors. You don't win any prizes for signing leases. You win prizes for having open tenants, right? So stay tuned, because we complexity, right? 1 minute Amazon's telling us they're coming out with a new grocery concept. Now, think about that for a minute. If Aldi went, and over a course of 10 years, got 500 stores in Florida, how many stores does Amazon need to have to truly be competitive? The answer isn't the 30 they got now. They would need to show up and open 200. They might have been on that track, but I'm concerned that this would be very hard, right? Fool me once, I don't know, right? Oh, no, maybe we're going to try it again. I hear some mumblings, they're going to try it again. Some of these stores will open. Some of them will not open. Some of these stores will be Whole Foods. How do you know if you're likely to have a Whole Foods? Hopefully you're not near one of the Altamont Springs, and they're getting ready to like do a bunch of construction, and then it's down the street from the Whole Foods. Like, I don't know, right? I don't know. Okay, part of this presentation today is, I don't know. Okay, you should be asking these questions. Here we go again. Dakar, 244 apartments. Okay, your apartments are kind of worth 500,000, it's like $500,000 bucks. Right? If they were worth $1 million, there's $250 million of stuff. They're not, but still $125 million of stuff. That's pretty amazing next to 50,000 feet of retail, right? So what do? You take 8 boxes, right? Burlington, DD's, Five Below, Home Goods, Old Navy, Publix, Ulta, marry it up with a ton of out parcels. That's one way to play the development game. Trick is going to be at $500 a foot construction above land costs, right? Are those boxes really paying you enough money where you're getting in a land of 8% interest rates, short-term interest rates? Is that really the return you want? I think not. Okay, that'll open in the fourth quarter. Here we are with the last stage project. Again, the third Terra project, staying with this theme. Now we have roughly 300 million of apartments tacked on to 75 million of retail. Right? Big costs, right? Big costs. Right? Multi-level tenants, Target, Sprouts, Five Below, right? Building in a really dense urban environment. This is hard work. This is not like when I was a little kid and you were buying cow pastures and throwing up the new Publix with the 4 out parcels and the 30,000 feet of locals. So we've done all of Dave. We've seen this theme of apartments. We've seen this theme of multi-story, right? Let's go to Broward. So Broward now, right, 2 million people, they get 1 project a year. Now, I'm talking projects are like over 75,000 feet. I'm sort of excluding freestanding boxes. And they get both of them last year, right? So you get phase 2 of Plantation Walk that's up by the Broward Mall, right? It's a redo of the old enclosed mall up there, right? So 700 apartment units, right? So what do we got? We got $350 million of apartments, right? And a redo of that. And then you get 16,000 Pines Boulevard, the Terra project, and instead of apartments, you saw Lenard townhouses next door. This was a post office, large post office sorting facility across the street from a Costco, Publix, right down the road from a Whole Foods. Publix opened a second store. This was originally intended to be a Lucky's. So Publix has 2 stores across the street from each other. That's not super uncommon, right? You can see that up at Altamont Springs, where Publix has 2 stores across from each other. You can see it at Coral Springs. I mean, it happens. This is the canary in the coal mine. This project was just sold to a non-traded REIT controlled by Apollo. You're going to see a lot of sales to non-traded REITs run by these large institutions like Apollo. This project sold for $10 million less than the cost. Okay? It's a really nice project. And this is the dangers of development when the rents aren't high enough and the cost, the inflation kicks in, and the costs keep going up, and you spend 3 years to build a project. Right? The post office ends up with that tiny building out front. Right? Palm Beach, 1.5 million people, 1 project last year. And that was PEB, right? Instead of doing apartments, they're doing senior housing next door. It's interesting, not to do what you did like they didn't watch me back there in a shock collar. All the profit, this project made a good profit. All the profit came from the out parcels. All the value associated with the Sprouts and the retail was practice. They got just as much dollars for selling that in the sale of this asset as they spent building that and buying the land. Right? So you could have said, well, the strategy may have been, let's just put this in and we'll wait. That could have been the strategy. We didn't get rewarded for activating that piece of land. And it's not like you needed a Sprouts to get a Wawa deal done, right? This is another part of thinking about development get your timing right. You know, just because that piece of land is ready to go, maybe the outparcel component's ready, and you need to wait a little bit longer until these rents, which are gonna go to the stratosphere, move to the stratosphere. Don't do the $20 Sprouts deal. It will be a $35 Sprouts deal. I'm gonna tell you why in a second, okay? But that's when you move and you pull the trigger and you do this. Sprouts will still end up wanting to be in West Boynton Beach. Okay, so 1/3 of the new centers ended up in Orlando. 2 came last year, 3 are coming online this year, right? We can see, right, with the exception of the one thing up in near Winter Park, right, everything happened in the same general spot. We're over in Disneyland, if you will, right? So Unicorp basically did Walgreens and some shop space with that signature, I can't find a parking spot in front of the store layout. Because, well, everybody, all the moms must want to park in the back and walk in. Now, this is what you get forced to do by the planners. It's really not that great of a strategy, but this works, right? So there's your almost 200 million of apartments next to your 50 million of retail. You didn't even have to worry about an anchor, right? Like, you know, but probably the city said, oh, this has to be mixed use, you're gonna have to do the retail. It may have made more money to simply do all apartments. Here's your $36 to $40 rents. That's tough, that's not giving you that big a return on these high construction costs. We go to O-Town, right? Unicorp does another thing, part of a larger mixed-use development, right? Here's our 900 units, maybe $400 million of stuff. We're going to go stick another 10%, $40, $50 million of retail next to that. Of course, the big green giant's going to show up and say, well, I need another store, I got more people. Every 10,000 people get a Publix, right? So time for another one of those things. And let's throw another 250 units next to it. And so you get this kind of a project, right? Going forward, you're still going to get this kind of project. You might not at a 70% discount are you selling the land to this person anymore, right? But in order to get this project going, now, just so you know, in Boynton Beach, there was no Whole Foods. In Doral, there was no Whole Foods. In Kendall, there's no Whole Foods. There's been deals made in each of those markets with Whole Foods by the same company. They're doing this layout without the apartments. Okay? And the rents now are in the mid-30s. Okay? And so that's the incentive that it's taking to get the developer to feel like they're making enough profit. The shop space are in the 60s and 70s. That's what we have to see before somebody brings some new toilet paper to the store, before new gas trucks show up. All right, Celebration Point, again in Orlando, same chamber they go to the other thing. Let's go build a Publix with some shops, and let's stick $200 million worth of apartments. Here we are, Water Star in Orlando. Let's do Burlington Marshalls and Pop Shelf. Let's try to get $55 rents. We certainly didn't get it from those companies. But let's try to get that, and again, we'll go put a couple $100 million worth of apartments next to it. Again, lots of these things that I looked at, I said to myself, I really don't know if I would have done those low rent deals with those big boxes if I should have done more apartments. But again, hindsight's 20/20. I can be the Monday morning quarterback up here. I can put your site plan up here every year. People are going to take us out of it. Everybody's like, oh, Dwayne's such a turd. Okay. We're still in Orlando. We're going to get a new project in 2023. Oh, there we go. Another couple $100 million apartments, right? Next to 75,000 feet. Whoa! I've got an Amazon Fresh. Like, do I? Okay, you're looking at a guy that thought he had a Lucky's, right? On Kaiba Springs Road and 436. and I thought I had a Kroger guarantee, and I'm like, oh, I got a Kroger guarantee and the Luckies. Now, what I had was an empty store, okay? And until I kind of like, sucked it up, I got a check from ripping up that lease. And I took 100% of that check, plus another couple $1 million to build a Sprouts. Okay, so sometimes when these things go wrong, even though you have a Kroger guarantee or an Amazon guarantee, you actually have a lot of work to do, a lot of wood left to chop to fix these things. So, we've seen 2 of these now in new car land. We only have 16 projects. Next year we'll all come back, we'll have a better clarity on what really happened here, but based on what's been happening so far, this isn't too positive of a situation. Remarkably, right, we get Sarasota Bradenton. We got nothing in Tampa, but we get 2 projects coming up in Sarasota Bradenton, right? So we get a Publix, 70,000 Publix and some stores, right? Again, maybe our land was cheap enough here, maybe our construction costs were cheap enough that we could deal with that $20 rent from Publix. We're not going to disclose, right, what we're getting from the shop space. We could really find that out. We'll leave that at that, right? And then we're going to go do Lowe's, Home Goods, Aldi, Crunch, right? This is a very classic retail project. Henderson's doing that, right? Again, rent undisclosed. But still, with the rents these tenants are paying and the high level of construction costs, it's very hard to make sense out of this. All right, I think we're almost done here. So we're going to get 1 project in Jacksonville, way down south, right? And it's a Publix and 12,000 feet, right? That's it. Right? We have 22 million people in the state. Every decade we're adding the population of Dade County, 3 to 3.5 million people. We build all of Dade County in terms of multifamily, everything that's there, we build that every decade. Right? But we've stopped building retail space. For as much retail space as I showed you here, we knocked down that much space. Use of the front row here, you just sold a project on Federal Highway in Lantana. Probabilistically, half of that retail space in that project they sold will be knocked down in the next 3 years. Right? So for as much as this new stuff, there's more. So if you remember my first slide when we passed peak retail, we've gone now past that. We have a blog where we list all the new projects that are coming. Every month we put every new anchor opening. We tend to put out there where are the anchor closings. Let me just give you a little bit, because I forgot to touch on that earlier. Last year in Florida, we tracked, there are 100 companies in Florida that live in big boxes. I'm going to find a big box, I think it's over 10,000. There are roughly 100 companies that live in the big box land. Collectively, they have 11,000 locations in Florida. And Woolbright has developed some technology where you can see every time one of those locations opens and every time one of those locations closes. Last year, there were 300 openings of those big box 100 companies. And there were 200 closings. There were some Tuesday mornings closed and then Bass closed. Yeah, so there was a net absorption of 100 boxes. You're like, well, wait a minute. There were only like 15 boxes on the slides today. Where did the other 85 go? Well, some of the 85 were like freestanding Dollar Generals and a little bit of that stuff, but not all of it, right? That's just how we ate up half the boxes in the last 3 years. You can't do that forever, okay? You can't go forward and we only have 22 million feet of vacant space in the state right now. The boxes alone absorb 4 million feet. Okay? Like you can't keep taking shirts out of the closet. At some point, you got to wash the shirts or buy some new clothes. Like you're going to hit a really unusual inflection point. Another point I want to make, 2 other points I want to make. So with this data of the big boxes, I can turn on the locations of any box and look at their network, right? So now I'm back into Dwayne College mode, big data guy, right? And I can see, for example, what was remarkable is when you do something like the Truist merger, you take BB&T and you combine it with SunTrust, and you utterly have dozens and dozens and dozens of duplicate branches that you have to close in order to make this new monster Truist work. Well, what was remarkable, I could easily do this for you don't have this toy, I can turn on all the Winn-Dixies and I can turn on all the Aldis, and remarkably, I'm going to share with you all, there's only 10 duplicates. You put 500 things together, right, and 250 and 250, and only about 10 of them aren't needed because there's something, there's a duplicate in the nearby area. That's pretty amazing, right? That's not going to happen when Kroger merges with Albertsons. There's going to be a lot of closings. But this was pretty remarkable. I don't think there's going to be any, I know the unions are pushing against this merger, but again, from an anti-competitive standpoint, if you've got one player, Publix with 900 stores, you've got Walmart with its big strength, clearly this third player, it's hard to make things that they're going to reduce the competitiveness of the market, especially when there's almost nothing to be closed, right? This is going on. The last thing I want to make, we didn't put a slide, so we didn't put that slide up because we showed too much secret sauce of how the networks combine, but take my word for it. That's a pretty remarkable thing. So that's not going to destroy anybody's shopping center. Right? There's going to be 10 of you that are be like, oh my God, I can't believe my Winn-Dixie's closing on me. It's like, Dwayne told me we're way short on boxes. It's likely that my box will be taken in pretty short order. It'll probably be grocery restricted, so you need to think about somebody other than a grocery store to go in there. The other interesting thing we're doing at woolbright, and I just see is, if anybody has a story, I'd like to, we got like 10 minutes left. We're experimenting a lot with AI. So some of the early things we're looking at with AI is, can you read this lease and write a formula to describe what the tenant pays in past years, right? You read leases and you go crazy, and it does a really good job. Okay, so it's only a matter of time before your Argus models or some of your pro formas, you just scan the leases into the computer and your little AI filter, which may or may not be built into Excel, totally reads the things and builds the mathematics for you. It's inevitable, right? That piece is coming. But the really cool thing, Mauricio, who's with me here, is back on the camera. We're trying to envision a restaurant going to the first floor of our office building. And our office building ceiling heights are like 8 feet. And we asked the AI to imagine sticking a glass atrium on the front of the building that's 1.5 or 2 stories high, excavating some of the floors so that we'd step down into the main restaurant, have high ceilings. And the stuff that the AI did, mid-journey, the drawings that it did were not only remarkable. Again, I've been banned from showing it to you here because it reveals too much secret sauce. But I'm happy to tell you, like, my wife was an architect. It's like, I can't believe graphic artists can do what architects do. I'm like, believe it or not, because like that day is coming. Okay, it's in fact, honey, it's better than you and your architect friends can do. It's pretty remarkable the photorealistic images and how easy it made us to talk to tenants about what this future looked like. So as you're looking at your cow pasture, as you're looking at knocking down that car dealership, because you're going to make that Whole Foods finally in Doral or in Kendall, right? The AI will totally help you visualize what that project can be. And those tools are really, they're here today, but they're going to get much better over the next 3 to 4 years. I don't think AI is going to get rid of the most important parts, which is bringing you into this room and interacting with everybody else. But it's going to make you better at doing that, right? So that you can show me your project because you have some renderings of that project. You can simplify this really complicated lease paragraph for me using the AI to have summarized and written a simple equation to describe what is going on. I guess the last thing to talk about, see if you guys have any questions. The last thing to talk about is just this insurance thing, right? So, we're supposed to be here sizzle and really positive. Many of you don't realize that insurance rates have tripled, right? So you had $300,000 in insurance bill last year, you're going to get $1 million insurance bill. Now, if you have a public lease, it probably excludes that increase. And so you're going to try to pass on to your small tenants a $7 square foot increase in their triple net charges. And that's going to go over like a lead balloon. So you're going to eat it for a while, and you're going to try to baby it into the system. If you're an apartment owner, right, that's part of why their prices fell to that $10 million house to me, and I'm only going to pay $3 million for it, because they can't pass it through to those tenants, right? They have to eat that. That's what happens in apartment land. And so they have been a double whammy of their NOI got hit, not by rents going down, but effectively expenses going up a lot, and then their cap rates been dumped. So we are going to build shopping centers in Florida. We're going to start building them in 26, 27, and 28. You're going to see nosebleed rents out of the anchors. For those of you that are reviewing existing box tenants, get used to getting nosebleed rents out of them, introducing them to them, because if you take note, there's virtually no boxes nearby where they can move to. And what tends to happen in development makes its way out into the rest of the center. So if you start getting $60 shop rents, you will start to get higher rents in existing centers. If you start to get $30 and $40 box rents in new centers, you'll start to get 20, 25, 30 in existing centers. Questions about it?
The sales can justify those rents.
So you ask an interesting question. The question is, how do retailers deal with ever-increasing rents? I'm not going to answer that question, very simple. So the average tenant pays 10% of their sales in rent. Let's imagine a tenant that's doing $1 million and selling dresses. I'm a greedy landlord, and I've been charging them $100,000 a year to have their dress shop in our shopping center. I've now become utterly and completely evil, and I'm going to raise their rent by 50%. They're now going from $100,000 a year to $150,000 a year. And after they take my picture off their dartboard, they will come to the realization that if they simply raise prices by 5%, which they got really good at doing during the pandemic, then their sales will go from $1 million to $1,050,000. My extra $50,000 in rent will be covered by that extra sales, and they will end up with the same amount of profits before evil Dwayne showed up and raised their rent from $100,000 to $150,000. The question you have to ask yourself in this room is, in order for landlords to get 50% more rent out of a tenant, can the tenant stomach raising their prices by 5% to get the exact same profits they had before I showed up and raised their rent? I believe they can. So the good news is, because we only take 10% of their stuff, we have a lot of capacity and can charge them more money. They will not break. They have made a lot of money. Your Publix, your Total Wine, you had 1 year where your sales went up 40%. You made a lot of money the last 3 years, okay? You can afford to pay a little more rent, but you can also afford to raise prices and you won't go out of business. Next question.
What do you feel about lithium batteries and fire sprinkler systems?
So the question is, what are we doing about lithium batteries and fire sprinkler systems? And so, unfortunately, I don't have a good answer. What should we be doing?
I don't know. Our market.
So we'll probably come up with some new technology, right? Something that's less flammable. We somehow figured out how to get lithium batteries on airplanes again, not in a great way, right? But nobody's phone exploded during the talk, thank God. So let's hope, right? Let's just hope we can. We're pretty creative at solving technological problems. I think we can do that. Next question. Yes. So what are my thoughts on the Tampa St. Pete market? So remarkably, the Tampa St. Pete market now has 6% vacancy. They had a 200 basis point improvement over the last 12 months. So I'm pretty bullish, right? I can't figure out why nobody's building anything new there. Right? There's decent population growth. There's lots of good job issues. By the way, Florida has 10% inflation. The rest of the country has 3%. So what happens in Florida doesn't necessarily happen in the rest of the country. And Tampa is a good example of a place that has really good growth. Right? I would expect that we could be at 4% vacancy rates in Tampa in the next 2 years. I think you're going to get this 10 and 20% rent growth in Tampa. What's interesting is what Woolbright like to do is we like to find centers that have 15% or more vacancy, and they're now like unicorns. Like, good luck finding. It used to be 1 out of 4 centers had 15% or more vacancy. Now it's much less than 1 out of 10. Right? So I'm very bullish on Tampa. I'm bullish on all those markets in Florida that have more than 1 million people. Probably the market I'm least bullish on is Jacksonville, because it's always been the laggard in terms of job growth and population growth, rent. And then that's translated into not so big rent growth. And then I have to compete against Tony Sleeman there as somebody who, like the 800-pound gorilla. So I don't want to lease against Tony. I'll just like, here, get all of Jacksonville. I'll take the other places. Other questions?
What's the next major market that you think is going to emerge?
Yeah, so you asked, what's the next major market to emerge, right? And that we're not studying, so it's probably Daytona in Florida. But I will add that it brings up an interesting question. We recently went, and we've looked at all the retail in Raleigh, Nashville, Charlotte, and you hear all these stories about, oh, how great it is in Raleigh and Nashville. But let me tell you, it's not bad there. It's the same as Florida. Okay, so you're not, pick an area here where you can be an expert at it, leverage your local market knowledge. The grass isn't greener somewhere else. It's not better in Atlanta. It's not better in Raleigh. You won't find any more value-add deals. We're building 1 center a month in a typical market here. They're building 1 center a month. Right? There isn't anything special you're going to find outside, but Daytona's growing you, and like that's probably the next thing that reaches 1 million. One more question. Come on, there's got to be an Elon Musk thing going on.
Nothing to do with Elon Musk.
No.
Restrictions and exclusives in these centers, obviously.
Yeah.
Boxes going away. Tenants, are they waking up? Are they getting more flexible?
This is a great question.
My next question is really tied to boxes do become vacant, that grocers control, food deserts. Is there going to be legislation that basically eliminates a lot of their ability?
I don't think so. Let me just, so you guys get the ball here. So the first question was just, hey, we get some crazy clauses in some of the existing anchor leases. If we move into a landlord's market because there's no toilet paper around and the spaces become harder to find, does the market start to swing the pendulum the other way and we can get rid of some of these things? And what if some of these mergers, for example, where the Aldi guys say that, well, you can't lease that former Winn-Dixie spot to a grocery store, and we end up with these grocery deserts. And I think first of all, that would be bad for Aldi because they would run into anti-competitive issues right during the merger. That question is going to come up. Would we make a food desert? It's pretty easy to show there's no food desert anywhere in Florida, even if you close these few Winn-Dixies that are overlapping. But clearly you're on the right track, right? This notion that one grocery tenant won't pay any increase in insurance costs, and now we're seeing the consequence that would have, devastating consequence on the rest of the center and on the economic value, right? So those things do swing back away, right? These co-tenancy clauses, these other things. You've got to imagine, you're a tenant, you just used your last option, you've got a store that's 50,000 feet, it's at the top end of your chain, there's no boxes for you to go to anywhere nearby. You might lose, one, your rent might double. You might go from $8 a foot to $16 a foot and match the last box tenant that was signed for that project. That would be reasonable. But you also might lose some other rights, like happened during the pandemic when you wanted some, oh, I want some rent abatement, great, I'll give you that, but you gotta let me, put a gym in one day or put, a movie theater in and so on and so forth. Well, that's all we have time for today. Thanks, everybody. I'll stick around up here if you have any other questions.
Get my hands